The municipal bond market is a far different place today than it was pre-crisis or 2008. Bond insurance is basically non-existent. Dealer inventories are at all-time lows. Odd lot penalties are as high as they've ever been. And oh, by the way, yields are likely rising rather than falling over time. So one question investors have to ask themselves is, why would they manage a bond portfolio the same way today as they did pre-crisis when the environment is far different? Quite frankly, the answer is you wouldn't, you shouldn't. So today what I want to do is go over the primary reasons or rationale of why an investor would want to invest in a ladder in today's environment. The first rationale I hear a lot is, I've never been hurt in laddering bonds. Well, that's not a surprise given that yields have been falling for the last 30 years. But if you look at it, if you compare tax-aware to a high-grade, say 1 to 10 year AAA ladder portfolio, a $10 million investment in 2008 in tax-aware would have grown to about $15 million. In a ladder portfolio, that would have grown to $13.2 million. So yes, you're not being hurt by being in a ladder, but you're clearly leaving a lot of money on the table. Investors don't care about return. All they want is their initial investment back. Well, most investors take income out of their portfolio. So let's assume you take out 5%, or a client takes out 5%, their coupon every year. A $10 million investment in a high-quality 1 to 10 year ladder today would be worth about $9.2 million. Compare that to tax-aware, taking out the same level of income would be worth about $10.7 million. So in a ladder does not guarantee that you're going to get your initial principal back, especially when you're taking out income. Another rationale is that my ladder will increase yields when yields are rising in the marketplace, which is true. A ladder will increase your yields. But a ladder doesn't have a lot of flexibility, and it's beholden to the shorter rung of that ladder. When it matures, those proceeds get reinvested. Tax-aware has a lot more flexibility to maneuver and to rotate a portfolio into higher yields that are being offered out there in the market. So yes, a ladder will increase yields, but in every period in which yields have risen, tax-aware has done a better job of more effectively increasing yields. Another rationale is clients don't want to pay a fee. Well, you get what you pay for. Is active management more expensive? Yes, it is. But when you look at AB tax-aware's returns on an annual basis versus a ladder, it outperforms by a wide margin. And more importantly, in environments in which the Fed is tightening, say 1994, May of 04, June of 06, the last time the Fed increased the Fed funds rate, tax-aware outperformed the high-grade ladder by nearly 175 basis points. So yes, tax-aware is a little bit more expensive than a ladder, but again, you get what you pay for. The benefits of an active strategy seem clear to me. All investors, especially bond investors, should have learned something coming out of 2008. And that is, you want your bond portfolio to be liquid, diversified, but more importantly, have the flexibility to tactically navigate an ever-changing environment. Ladders, by their definition, do not offer and have that flexibility. AB tax-aware inherently has that flexibility to tactically navigate, whether it's by utilizing taxable bonds, municipal credit, or adjusting along the yield curve. AB tax-aware has proved that we can outperform a ladder in all environments.